On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the On the Tape podcast. I am Dan Nathan, joined as always by Guy Adami and Liz Young, that would be EY, from SoFi. Welcome, folks.
Hello.
What up?
We got a big pod, okay? Just first and foremost, Guy and I had a great conversation with John Brignola. He is the founder of LBC Credit. We talked all about private credit. Seems like that's all that anybody wants to talk about every day. I open up my FactSet, my Bloomberg, the Wall Street Journal. There's an article on the front page about private credit. We give his take on the market and maybe some of the risks, some of the regulatory situations coming down the pike. We talk a little bit about M&A. We're going to talk about M&A. Guy, you had a really prescient call that U.S. Steel. Remember we talked about that a little last week. You're like, you know what? This thing's not getting done at 45. And here we are. We wake up on a Monday. It gets done at 55. Nostradamus again at it. So we're going to talk more about the M&A environment. There's actually still a bunch of earnings this week, and I think some interesting names that might give us a good read on the consumer. A lot of housing data this week. We're going to talk about some of these targets. But first and foremost, let's do a little housekeeping here. What do you think, Liz?
All right. What's going on in the house?
If I threw out these names to you, let's do like some name association here a little bit, okay? What is something that all these names have in common, right? So it'd be Keith Richards, Steven Spielberg, the great and recently departed Ray Liotta, Brad Pitt, Katie Holmes, Christina Aguilera, and Billie Eilish. What would you say about all those folks?
Late and living legends.
Legends, right?
Absolutely.
Very and really talented people, right? For the most part.
I mean, incredible.
They all share a birthday. So today is Deck 18.
You don't
say.
Yeah,
they all share a birthday. But you know who else? A very talented man who also has a birthday on Deck 18.
I'm at a loss. I have no idea.
Well, that would be Guy Christopher Adami. Look at that guy right there. And the beauty of today is not just like all those folks, they're sprinkled over decades. You know what I mean? Where they were born and stuff like that. Guy's probably more close to Steven Spielberg and Keith Richards, but he shares a birthday with Brad Pitt. I mean, like the actual
birthday and year.
Yeah. How about that? So, Guy,
he hates
happy
he's
birthday.
So mad at us right now. He's like,
can't say a word. Just do us one favor, people. If you're listening to this, get on the socials. Get Guy Adami trending. Let's do it, okay?
Today, the heck out of him today.
Yeah. Blow it up. That's what they say, right? Blow it up or blow it out, or that's
Guy,
that's
are you cognizant of all of these very, very talented birthday folks on that share one with you?
You know, you look up, you see who's has the same birthday as you, and I've always been shocked at the amount of really interesting people across a swath of industries. But you're right, Brad Pitt and I are the same day. Charles Oakley, one of my favorite Knicks of all time, is also a December 18th, 1963 guy. So yeah, throw that in a pipe and smoke it. Yeah.
Fair enough. All right, Guy, we wish you a very happy birthday. We hope you have a great one. All right, let's get to this here. You know, the last couple of weeks, we've just been kind of digesting a lot of Fed speak and at least investors, what they perceive to be a massive pivot. We all saw this coming. I mean, that's the thing that I think is kind of interesting. A few months ago, there was still a 25 basis point hike priced in, right? And then latter half of 2024 is when maybe a few cuts started to work in. Well, that's all been pulled forward dramatically, and it's caused an orgy of buying. What are they calling it? I know the guy loves this term, the everything rally, Liz.
Yeah.
So here we are.
Rising
we wake up.
Tide, all ships, something like that.
I feel like we're going to wake up every Monday morning for the next kind of month or two. And it's going to be, strategists tripping over each other to raise their targets and come up with rosy reasons to kind of stay very constructive, which is fine. It's kind of what most of them do. It was not too dissimilar to what we saw at the end of last year, where there was a lot of pessimism. A lot of the bullish strategists threw in the towel at the bottom, and then the chase was on in January and February. So let's talk to us a little bit about this. When you see Goldman this morning, their target, is, going above somebody else's, and that's been ratcheted up just in the last kind of few weeks. David Kostner writes, equities were already pricing in positive economic activity, but now reflect an even more robust outlook. Talk to me a little bit about this.
Yeah, I mean, I don't know that the outlook is necessarily all that much more robust. I think that the broadening of this rally is what people are chasing, and what's caused everybody to sit back and say, all right, did we think about this the right way? Because there has been the argument throughout all of 2023. We had a lot of attempts at broadening out in the rallies, particularly in July. And a lot of these sectors did participate then. We had small caps really come back off the mat. We had a lot of sectors rotate in, and it looked very promising, but it never quite got above where you want it to be for breakout reasons. This one looks a little bit better. This one looks stronger. And obviously, we've made new all-time highs in the Dow. We've got a bunch of Russell 2000 stocks trading at 52-week highs. So those are promising things. And we're still in this period of time where it's almost as if innocent until proven guilty, right? We've got an expansion that is losing steam, but not contracting. We've got inflation that's coming down to a much more comfortable level. So there are things to celebrate. And I know we'll talk about my outlook later. As a strategist and as people who try to figure out what's going to happen at the end of the year, first of all, I have to say I'm grateful that I don't have to do that. I don't have to have a price target, because any of them who even have to have them would tell you it's a really difficult, if not impossible game. It's like pinning a tail on a very small moving donkey. And they're going to have to adjust it again, more likely than not. So it's a tough thing to do. But I also think that there's this ability as a strategist and this necessity as a strategist to prove that you're not doing it with your head buried in the sand. You have to recognize what's going on. And yes, there are things to be worried about, but the market is the market. The tape is never necessarily wrong in the moment. And you have to recognize that there's a lot of buying opportunity that maybe people missed out on in October, November-ish, when this rally was questioned.
So, Guy, what do you make of that comparison to, let's say, the start of 2023, where the market had been rallying, right, into off of the October lows a little bit, and it seems like the chase was on in January, the January effect, all that sort of crap. But what's different now, and I think this is the point of Costin's note, is that the sentiment has massively shifted, right? So we are literally firmly in that soft landing, and that's maybe that's the thing, the disconnect, the difference, and maybe why it doesn't go the same way. That all that being said, a lot of folks have much higher year-end price targets, 5,000-ish or above, and we're not that far from that. But a lot of folks are also saying that they could see the first part of the year as kind of rocky. I don't love that consensus either, Guy.
Well, that's seemingly, we've had a few people on Fast Money. A bunch of people have come on the podcast and said similar. The first half's going to be rocky, only to have a recovery in the second half, probably bolstered in large part by Fed cuts, a reacceleration of the economy, and we're going to close next year, 5,000 or north thereof. So that seemingly now is consensus, which is somewhat alarming, I think, because typically when everybody thinks the same thing, the opposite happens. But your point is well taken. I mean, we went into this year, in 2022, 2023, with, I think, peak pessimism, only to have now probably peak optimism going into 2024. But I'll say this, Elizabeth talks about this. We've brought it up a number of times. Seemingly, strategists are making the same mistakes they made probably 14 or 15 years ago, when they're starting to ratchet up earnings expectations in the face of leading economic indicators being down now 19 months in a row. There's a swath of things people should be concerned about, but are seemingly turning a blind eye, thinking somehow it's going to be different this time. The data suggests, and Liz can talk about this as well, but the data suggests this is pretty robust late cycle, things we've seen before, but we're probably seeing it in a more, vociferous way this time. The I guess, cascade of optimism, I've never seen anything like it in a time when people should be anything but optimistic, in my opinion.
Yeah, and Mike Wilson from Morgan Stanley is out with a note this morning saying over the past month, we've experienced arguably the best stretch of breadth improvement in 2023. This is an encouraging sign. Small caps look very compelling given higher probability of accommodative monetary policy. So, okay, so Mike remains structurally bearish. He, to Guy's point that he just made about late cycle sort of behavior, that's kind of what he sees as going on in the economy right now. And regardless of what's going on in the stock market, we highlighted the fact that yes, the IWM, the Russell 2000 small caps, outperformed the S&P, I think by 1.5% off the October 27 low, but they're still down 20% from their late 2021 highs. So can you be in the camp that accommodative Fed policy coming in the not so distant future is going to be good for small caps, which have underperformed over the last, call it 2 years, but also maybe that we're going to see a material slowdown at some point? Sure. You know what I mean? Can small cap stocks work, but have a broader slowdown? You know what I mean? Does that make sense?
Well, and I think a lot of this ends up being just an argument over your time frame. So if you think about small caps in general, if most of the correction was caused by the fact that rates went up, capital constriction happened, and small caps generally can't internally finance finance their growth. So they have to go to markets, debt markets generally, to finance what they're doing at the company, then yes, lower rates should give them a little bit more of a tailwind. I would still concentrate more on something like the S&P 600. It goes through a profitability screen. It goes through a little bit more of an earnings momentum screen. So you've got companies that are higher quality. But what would happen in small caps, you have to think about what's the bigger driver. Is it rates? Even in a drawdown, rates will continue to come down. If we do have a recession, the Fed will cut to try to stimulate. So that is still a tailwind. But yes, small caps would get hit in that environment. If your time frame is long enough that you can look through that, right? I think right now you probably can enter at a more reasonable valuation, but that's always going to be, there's always going to be a group of stocks. I could say the same exact thing, replace the word small caps with international equities, replace the word small caps with some sector that hasn't done well, right? There's always going to be something out of favor. Value stocks, you could say that right now.
But time horizon, to your point, is actually the thing. But like if we're gonna go into a recession, small cap stocks are gonna get hit the hardest, in my opinion. So like, I don't think the timing of chasing them after a 24% rally makes a lot of sense, especially if you're in a camp where soft landing consensus might be a little worse than what consensus is expecting. And Guy, I'm just curious. This is from Bespoke late last week. The small cap Russell 2000 index made a new 52-week high today after hitting a 52-week low just 48 days ago. That's the shortest turnaround time in the index's history. So when you see that, like, you don't want to chase that, man. Like, am I right? I'm leading the witness here a little bit, but I see stats like that, and some folks they see it as confirming their bullish thesis. I actually see it the opposite way.
No, I agree with that, but I would have said prior to that there's no way in the wake of, listen, I understand the last unemployment data was better than expected. Obviously, the unemployment rate went down. However, given what we've seen of a swath of different companies over a bunch of different verticals, people are getting fired. I mean, layoffs are happening, which is, again, typical late cycle stuff. So I would have interpreted that and say there's no reason to chase small caps at all because they're going to be hamstrung by bank credit contracting and unemployment rate going higher. That would have been wrong as well. But the duration with which we went from lows to highs is startling. And a large part of that is due is obviously 10-year yields moving 110 basis points from 5% below 4%. And that helped a lot of these regional banks, which are a large component. But the catch-up trade is alive and well right now. People are actually flocking to these names thinking, you know what, it's just a matter of time before the S&P is effectively making all-time highs, the NASDAQ as well. The Russell's going to catch up. I just don't see it in this environment. But you know what, Dan? I would have said the same thing 3 weeks ago.
It's interesting. It seems like some folks within the Fed, and we talk about all the time how focused, let's say, the Fed is to the stock market, and a lot of folks kind of disagree on this issue. But it looks like that a lot of these Fed governors and speakers came out late last week, right? So the S&P is literally up 15%, what looks like a straight line, since that late October 27th reversal day, and loosening of financial conditions, Liz. I mean, like think about it, right? So mortgage rates have come down. We've seen housing. That's one of the reasons why we want to kind of track some of this housing data this week and just give us a sense for some of the consumer confidence data was better than expected. So, the consumers are feeling good. Rates come in just a little bit on the mortgage, maybe get some activity going there. People feel a bit wealthier with the stock market going higher, whether they own them or not, right? Just the perception of it. So are they trying to throw cold water on it because they see the potential for just a continued rip, and then all of a sudden, how can you lower interest rates if the stock market is making new all-time, if the housing market is kind of coming unstuck, if consumer confidence is peaking? Isn't that the sort of stuff that they were trying to raise rates to kind of tamp down a bit?
One of the things that I think Powell did a decent job of in the meeting last week was distinguish between the fact that, yes, financial conditions can loosen. That in and of itself is not necessarily the problem, but what it does is it makes the challenge that they have more difficult, the challenge that they have to lower inflation. And he indicated it would take longer to do so, right? So that to me was a subtle way of saying, stop forgetting about the fact that we told you rates were going to be higher for longer. You've all suddenly forgotten that we said higher for longer. The stronger growth is, the stronger consumer sentiment is, the stronger the market is, the longer we're going to have to leave them elevated. And that continues to be the case. So I think maybe that's what the other Fed governors are trying to push back on. Look, it's not working. The market still is pretty convinced that we're going to get the first cut in March, and that may or may not be correct. But I think they're trying to push back on it simply because they're saying the market has declared victory, right? The market has completely declared victory, declared that the soft landing is happening or even already happened, and inflation has been solved. And there's a lot of people at the Fed just saying that's not entirely the case yet. So slow your roll.
Yeah, Guy, but like the point is we're at 4719 in the S&P 500. The all-time high was 4800 the first week of 2022. Let's just say by the time we get to the Fed's meeting on January 31st, right? And everyone's going to be looking for clues. It could be one word. It could be any, right? Like something like that, right? They're going to be looking for clues. How can the Fed, if the S&P is at all-time highs, how can they hint of cutting at their next meeting in March? Like, I just feel like that would kind of, or is it to sell the news? Like, you know what I mean? Like, I don't know. But like, my point is, like, I think their job gets much harder from here with risk assets where they are.
I agree with you. And if it was just through the lens of the stock market, 100%. I mean, the bull case has been for a while that, you know what, they'll navigate unemployment. It'll tick higher, but it won't go higher in a meaningful way. I mean, if you look at the last reading, that's sort of what's happening, number one. Number two, they're also sort of hinge on the fact that inflation is still growing, but it's moderating, right? It's growing less fast than it has been. And you know what? If we just keep doing what we're doing by the natural course of events, it's going to trend down to our 2% target. Under that backdrop, I mean, I guess effectively they can do it. They can make those cuts early next year. I'm still of the belief that that's not going to be possible because, you know, I think you're going to see this reacceleration of inflation. And I do think despite the fact that unemployment ticked lower last time, maybe for a number of different factors, it's going to start to move meaningfully higher. But I guess to answer your question, the bull case is playing out. So the folks that have been saying this now for the last 6 to 9 months, how they can sort of stick this landing and thread this needle, well, right now it appears as though they're doing exactly that. I just don't think it can continue on this trajectory.
Yeah, and it's also really curious. It was, I think, that last week in October, Guy, when Rick Santelli from CNBC was in town. Remember, he did this chart on our show. He was doing it by hand, and this video caught a lot of steam. Liz, I don't know if you caught this, but he said, "Be prepared for rates, you know, above 10%, maybe as high as 13%," and that was it. I mean, that was the top. Okay, and you know, I think that month, Jamie Dimon was saying 6-7%, you know, maybe higher, that sort of thing. So it is interesting. And the Jamie Dimon one is really curious because here's a guy who has presided over from the pandemic. And he was very clear about the mistakes that some of his peers made, right? Like buying treasuries when they were yielding nothing at the bottom, that sort of thing, right? But he's also been really pessimistic over the last, let's call it 18 months or so, calling for an economic storm, you know, calling for these So how can a guy like that, who has all of like the purview that he has about the consumer, about just, you know, corporations, about how can he be that wrong about what's gone on over the last 18 months and what might continue to happen?
We could sit here and argue about what does wrong even really mean. Jamie Dimon is somebody who was at the forefront of the financial crisis, not necessarily because they caused the whole thing, but at the forefront in the sense of having to be one of the mouthpieces and one of the decision makers of how to save the financial system, right? And if you look at what a lot of people are doing right now is trying to compare this period to historical periods. And the bull case would be, it's much like the mid-90s, right? They pulled it off. There was a soft landing. We muddled through. The market did okay. There was no crash until early 2000s after we all know what happened then. Or you could compare it to the financial crisis, where it was this like long and protracted, still grind higher in the market. And what if this is a period like December of 2006, where in 2007, yeah, some bad stuff happened, but the market didn't really fall apart until 2008, right? So we just had this sort of, again, grinding through 2007. Maybe Jamie is looking at something like that, looking at the length of time that it took. And this is also a point that Jeffrey Gundlach has made. Things take a lot longer than we think they're going to because we're just impatient as humans. We're impatient as investors, but that doesn't mean that they're not going to happen. So I think Jamie Dimon and maybe Gundlach at the same time are thinking that same thing, that it's near impossible and frankly has never happened before that the Fed has actually pulled something like this off with this much constriction, and that the market gets this far away from itself, this bifurcated, this expensive, without having some sort of, I don't want to call it a catastrophe, but having some sort of come to Jesus.
Well,
on the
they
other
had a
side.
near catastrophe in March of this year. And, we've talked about it a lot. I mean, by backstopping deposits, by, like despite QT going on, infusing a bunch of liquidity. I mean, that was the thing. And I'm not saying it was like the Lehman moment, but it could have been or should have been. And what happened, obviously, in 2008 is that they were very slow to act on a lot of those big, you know what I mean? Yes, they cut rates and stuff, but like, TARF and all that sort of stuff, was always, you know what I mean, a little too late, I guess, so they learned some lessons, Guy, about that, because to me, if we had, had those bank failures without the extraordinary measures that the Fed took, we would have had that recession that the stock market was pricing late last year.
It's interesting. The counterfactual is always tough, but you're right. Probably the best thing that happened to the market this year, oddly enough, and you go back and sort of look, because if you think about what was happening prior to, things were starting to deteriorate in terms of the market and stuff. And then obviously it sort of cascaded into Silicon Valley Bank and a couple of those other regional names, and that proved to be the bottom. So earlier this year, the best thing that happened to the stock market was exactly that, somewhat counterintuitive, right? But to Liz's point, and I think to Jamie Dimon's point, he doesn't appear to be on the right course now in terms of some of his prognostications, but it doesn't mean he's going to be wrong. And when the most important banker in the world says the things that he says constantly now, pretty robustly over the last 6 to 9 months, if not longer, you have to take notice. And quickly about Rick Santelli, you're right. Within a couple of weeks, he had top ticked it. But, one of the things he said, through 4 3/4, you're probably going to see 5%. That happened. I don't think he thought we were going to trade down below 4%, but he also thought over the next few years, you could see rates meaningfully higher. So there's still a lot of chapters left in this book. And I'm not one to just say Jamie Dimon was wrong out of hand, because I still think he's onto something.
One of the things that I think we should all keep in mind, too, is the rescue or whatever we're calling it for the regional bank crisis that happened earlier this year. That bank term funding program that was put in place to protect depository institutions is scheduled to end in March of next year. And if that gets extended, it should send a signal that, okay, we're not quite ready to take the punch bowl away. We're not quite ready to take the safety net away. I would expect that it probably gets extended, or maybe the end of it gets softened, because if you rip it away suddenly and something goes wrong, then we have a problem. But that's something that I think we should keep on our radar. It doesn't get talked about very much, but there's less than 3 months of that left.
Yeah, so it's hard to think about, so we have all these rosy outlooks by all these strategists. That's kind of how we started out a little bit. What is the thing that kind of derails the economy? What is the thing that causes unemployment rate to go above 4% and then possibly 4.5%? Is it something domestic? We know it's an election year. We know that there's going to be a lot of pressure on the Fed to keep, conditions fairly easy, right? And I think of it, and it really has to come from outside the U.S., Guy. You know what I mean? And we've talked about some of these geopolitical hotspots. It doesn't seem like the situation in the Middle East is going to get better anytime soon. So that's going to be something that might cause volatility in commodities, right? It might cause, some major schisms between us and some of our, allies or supposed allies in the Middle East, and what that might mean again for crude. And then obviously there is China in Taiwan. But, I think that we've spoken about this a lot. I mean, China's weakness in their economy and just this kind of back and forth. It seems like every week we'll see new headlines, Guy, about, to stimulus or not to do stimulus, you know what I mean? And it doesn't seem like they're that supportive right now of the economy. I'm just hard pressed to think of something, like what could happen from within that would cause a material weakening of the economy. I mean, the Fed did tell us they're expecting GDP to be 1.4% next year. That doesn't seem like that robust. You know what I mean? It would take not too much of a shock somewhere in the system to cause things to materially slow down.
I just think you have to let time play out. And again, I'll say I thought things would happen a lot sooner than they have, or inevitably will have, but it doesn't mean they're not going to happen. And now you go back, I did a lot of reading over the weekend, just looking at late cycle stuff and where we are. Money supply has been contracting. I mentioned leading economic indicators. Credit card rates are now north of 21%. Credit card debt is north of $1 trillion. There's so many things out there to be concerned about. And, we talk about this, we seemingly forget 2s10s are still inverted to the tune of about 50 basis points. And if we make it to February, that'll be the longest inversion, I think, since they started keeping records here in the United States. And each time, and you go back and look, the longer the inversion, the worse the downturn. And we're on the precipice of a record inversion. So none of these things are going away. And I don't think there's a magic wand or some elixir that's going to fix these things. Again, I just want to emphasize, I'm shocked at how long it's taken to sort of for the market to realize it. But it doesn't mean there's some, to Liz's point earlier, come to Jesus moment on the horizon.
Yeah. And Liz, you just spent some time, I'm sure you were very reflective writing your 2024 outlook. Anything, and again, we're going to put in the show notes where people can find that outlook. It's also obviously on your socials at Twitter and the like. Any like one or two things you want to take out that you kind of weren't given a lot of thought to, let's say a few months ago, but like are top of mind right now as you're heading into the new year?
Yeah, I would just say I haven't changed my mind that we have to have some kind of contraction, or that I haven't jumped on the bull bandwagon and said, okay, you know what, we solved it, everything's going to be fine. What I did adjust in my thinking was maybe it doesn't have to be some huge event. It doesn't have to be some big dramatic thing that takes it all down. Maybe it's a slow grind lower that occurs because consumers start getting tapped out, because the job market softens, maybe just a little bit too much. And the path by which we get there might be different than what I expected. One of the things that is later in the outlook, I talk about being wrapped in contradictions, and we're going to start this year wrapped in the same types of contradictions, where you've got this set of nagging negatives. Guy mentioned the yield curve inversions. We've got PMIs in contraction. There's a lot of different things, the timing of rate hikes, all of that are nagging negatives, but there are promising elements. And then later talking about the idea that a bet on a soft landing is a bet on the consumer. So we better hope that the consumer holds up if we are declaring victory on a soft landing. And probably one of my favorite charts in the whole outlook, it's called Income and Consumer Expenses since December 2019. And then we separate out 4 categories: food, energy, shelter, and transportation. Cumulatively, those 4 categories in order are up 25.2%, 26.4%, 20.5%, and 26.1%. Wage growth is only up about 20.5%. So it hasn't kept up. And this is the part that maybe it doesn't take the system down in grand fashion, but this is why consumers are spending more on credit cards. It's why buy now, pay later is so popular, because expenses are still high. So we would need to see some deflation in order to take care of this. And I am not convinced that the market is going to like deflation as some kind of bullish signal.
Yeah. Let's talk really quickly about housing because, again, there's a lot of data this week. Our main man, Carter Braxton Worth of Worth Charting, had a note out this morning talking about how he wants to fade them from a technical perspective. Guy, some of the moves that we saw last week when, the 2-year came in, 50 basis points or something over the course of the week. We saw the 30-year mortgage get below 7% for the first time in a little bit. It got as high is 8%. On one of those days, Toll Brothers was up 9%, making a new all-time high. I mean, that just seemed extraordinary. Talk to me a little bit about your thoughts here. If you are buying Homebuilders up 50% in 2 months at all-time highs because you think a soft no landing is going to be great for the housing market, I don't know how that works. It feels like an accident waiting to happen.
This is where it gets dicey, I think, for home builders. And we mentioned, I think, on Fast Money last week, Toll Brothers announced a big stock buyback, and people took that as, they're encouraged by what they see. And I would agree with that, but it doesn't mean, they just have a stock buyback in place. There's not some accelerated stock buyback at $102, just to keep that in perspective. The other thing people will look at is rates are lower. That's good for home builders. I get it. And the fact that on valuation, you can make a case for all these names, but that's always true. And quite frankly, valuation is probably the last thing you should look at when you think about home builders. One of the things that I've said, and again, it's been wrong. It's funny. We actually did really well with home builders most of this year. We thought they could continue to rally. We thought there'd be a point in terms of yields going higher, sort of a line of demarcation where home builders would no longer like it. That proved to be about, 4.6%. You saw what happened from, I want to say, middle of September into November, and then you've seen the turnaround. This is the part that's confused me. I guess not confused me, surprised me with the speed with which you got in here. But I don't think now's the time to be buying home builders as well. As a matter of fact, technically, there's a very good chance you put in some of these potential key reversal levels on a bunch of these names, not least of which Toll Brothers. So I understand the thesis behind it. I don't agree with the thesis behind it.
Yeah, I mean, the home builders are one of those sectors, and much like small caps, so responsive to cyclical factors. And one of the things that, if we change the time frame a little bit, when we think about mortgage rates, one of the things that I said a few months ago, maybe just a couple months ago, is that the expectation for this whole cycle has been that housing was going to eventually fall apart, that we'd see home prices fall because mortgage rates were so high. And what I think most people, self included, did not adjust for is the fact that the housing market just stopped moving. There was nothing happening because people just decided not to exit their current mortgage. So the idea that as rates fell, because it's a relative thing, right? They went from above 8 to down below 7. People were clamoring over themselves that hadn't been able to buy homes. So it kept prices elevated. It kept sentiment maybe somewhat elevated. But the reality is the whole reason people were still able to move homes in the new homes market was because home builders were giving some incentives. You could get a better deal to buy a home in the new homes market than you could in the existing homes market. And I think those days are probably over. So we're going to end up at this place where I would expect we have more inventory coming on the market in housing than we will have buyers clamoring over themselves at 6% mortgage rates to buy it. So there should be a softening. It's just such a lag. I'm with Guy. I think you don't want to fall over yourself to pile into home builders at this point.
Guy, let's talk a little bit about M&A. So there's two competing headlines this morning. We kind of alluded to U.S. Steel being bought by Nippon, which is a Japanese competitor. Again, you didn't think that $45 number that was thrown out there by a couple of bidders would be the thing. I think your point was if there's a couple of bidders and the leak is $45, it's likely to come later, or higher, excuse me, and $55, $14 billion is the price. And then another headline is that Adobe is calling off their $20 billion acquisition of Figma, which I think is interesting. And that faced a lot of regulatory pressure. So two competing headlines on a day about, pretty decent size M&A. Thoughts here, Guy, because it feels like when we turn the calendar into January, there's going to be a lot of strategic M&A considered, especially with rates coming down. Maybe that was one of the things that kind of seized up that sort of activity earlier in the year, especially a lot of the uncertainty about the macro and just the economy here, specifically in the U.S. in this regulatory environment.
Yeah, I mean, Adobe's probably Adobe or sector specific, and you know more about this than I do. I'll say this about U.S. Steel, and we mentioned it last week. With 5 bidders in the name, I think the stock closed around $38 or so. I said there's a very good chance this deal happens north of $45. I didn't think it would be Nippon, but it doesn't matter. But I also didn't think it was going to be $55. So it's exceeded my expectations as well. But I think your point is exactly right. With rates coming down as fast as they have come down, I think there's going to be a rush to do M&A in an environment where people see how quickly rates can go the other way. So I think there's going to be this opportunistic move in the market for a lot of companies coming together over the next few months in probably, trying to get ahead of maybe the inevitable that rates start to head higher as well. So we'll see. But you could see some really interesting deals. And we've seen it in the energy space. Obviously, this U.S. deals in the resource space. We've seen it in the healthcare space. I think you're going to continue to see more of it, Dan.
All right, let's talk earnings real quickly. There's a few out this week that I think are going to be, fairly telling. And I'm just curious, maybe Liz, from a sector perspective, if I said to you, FedEx reports tomorrow, Accenture reports tomorrow, Micron on Wednesday, and then on Thursday we have Nike. And then here's a pair that are kind of under the radar, but this is Cintas and Paychex. Okay. So Cintas is this, uniform provider, right? To, companies of all sorts. And then Paychex, which obviously payment processing. And I'm not asking you specifically on any of these names, but are you interested? Because I know that you look at a lot of earnings, you look at a lot of what C-level folks are saying about their own businesses and about the economy. Any of these names interesting to you, like that you want to extrapolate from based on what you hear from?
FedEx. I think FedEx is probably the more interesting one, just because I'm pretty obsessed with consumer behavior right now and what people are doing and buying, especially during the holiday season. Now, FedEx reporting now isn't going to give us a huge lens into the holiday season, but just the activity perhaps leading up to it and the idea that retail sales have have rebounded. People are still spending. I'd be really interested to hear not only what FedEx saw last quarter, but what they're expecting for 2024, and if they're expecting there to be a softening in activity because we've made this huge transition from consumers buying goods to consumers now engaging in services more. So I would expect a little softening there, but very interested to hear what their outlook is.
So, Guy, FedEx has rallied 25% in the last, like month and a half or so. It's still down, let's call it 10+% from its all-time highs made in 2021. You have this sort of rally. You've had all these labor issues this year. You've had a lot of poor visibility as it relates to the consumer and some other, behavior as it relates to, the changing landscape, I think competitive landscape for them. Curious, if you're if you don't have a lot of visibility, are you going to give gangbusters guidance after your Q4 that should be excellent? You know what I mean? Like this is their quarter. To me, I would almost think that as we get into Q4 earnings season in the next month or so, that we're going to see a lot of cautious guidance in a market that has already pulled forward a lot of enthusiasm, right? That might not have to do with a lot of single names.
You mentioned the move we've seen over the last couple of months. I mean, FedEx has probably rallied close to 100%. I would say a little less, maybe 96% since the lows we saw in September of 2022. And it's been this slow and steady, despite one little move from the lower left to the upper right. All the FedEx problems we saw to a certain extent in 2021, 22 were FedEx induced, FedEx specific, seemingly getting their act together. But they're getting their act together at a time when things, I think, the rug is going to start to get pulled out from beneath them. They've had obviously the tailwind of lower energy costs. There's a lot of things working in their favor, but we're getting precariously close to the all-time highs we saw, I want to say in the spring, May of 2021 or so. There's a chance we just continue to do this grind into earnings tomorrow, and then you get a rug pull on the back of something unexpected, which we have seen before in a negative sense in FedEx. That's sort of what I'm looking for, just in terms of trading the stock.
Yeah, one name that I think it'll be interesting, at least from the investor reaction, will be Nike, because the stock has rallied, let's call it 35% off those recent lows. It's still down over 30% from its late 2021 highs. And so when I think about what they have to say geographically is going to be kind of interesting. Obviously, higher end consumer discretionary. This should be their season. I know there were some analysts out talking about the Paris Olympics this summer. I always think those are kind of goofy calls, you know what I mean, in front of a big sporting event, that sort of thing. But to me, Nike's reaction, let's just say it's a good quarter. Let's say they give decent guidance. The stock, again, has had this huge rally over the last couple of months. To me, those are just kind of really hard stories to chase. And, it leads me to a Starbucks, because there was a time earlier this year where Disney, Starbucks, Nike, some really high-end consumer discretionary names, they were all acting so poorly, right, relative to some other names in consumer. And then there's been this little bifurcation. It's interesting. Starbucks, Guy, when they reported a couple months ago, stock had a big gap, kept on going. I think it got above 105. Here it is down at $97. It's basically filled in that whole gap. So again, Danny Moses says this all the time, this 2024 might be a stock picker's market. There might be more dispersion as it relates with all of this uncertainty. We might see continued volatility, maybe on single names. We may see, parts of the market, like we talked about, Russell, outperform other parts of the market if we are really seeing a broadening out of the rally, that sort of thing. So those are things, I guess, we all got to be cognizant of. Guy, thoughts on that?
If you look at Starbucks, you're still in a pretty significant downtrend. Despite that spike higher we saw after earnings, we're still in a downtrend over the last couple of years. And I think you had 8 or 9 straight days of the stock deteriorating, which we hadn't seen in quite some time. Nike is fascinating here. You obviously have these little double bottoms technically, if you want to go back and look at the lows we saw in the fall of 2022, and then again the lows we saw in September of this year. If you go and look at this, 127-ish stands out like a sore thumb. That was sort of the highs we made in January earlier this year. There's a really good chance we sort of levitate up to those levels and fail. And the same way you saw double bottoms a month or so ago, I think there's a very good chance you put in a little double top here on the back of earnings.
All right, we covered a lot of ground here, a lot of data, a lot of earnings still to happen, a lot of chasing going on in the stock market, maybe some broadening out, maybe it's a dash for trash. Who knows? Check us out on the market call. Guy and I will be here Monday through Thursday, 1 p.m. on our YouTube channel. That would be the Risk Reversal Media YouTube channel. And people, go get Liz's 2024 outlook at the SoFi Investing blog, because this is the last of her, the last of Liz for 2023 with Guy and Dan. And you deserve a little time off. I'm sure you're going to be working, not with us.
I appreciate that. Well, I wanted to go out on Guy's birthday and celebrate.
Very kind of you, EY. Very kind.
Yeah.
Well, I'll just say this. I know that Guy and myself and our team will be in constant contact with you, but I guess you won't be.
Yeah, I'm not done talking to you guys. Yeah. I'm just done on the mic.
But we really appreciate your contributions this year. We appreciate your support. We appreciate your friendship. You've always shown up for us. And listen, it's been a lot more fun than just Guy and me having Liz around. Guy, I'm sure you could second that.
100%. Without question. We enjoy not only your company, but your brilliance in terms of the market and your preparation. So thank you for all you've done for us, EY.
Thank you. And I will see everybody in 2024.
Yeah. Have a great Christmas, everyone. Guy and I will be back. You don't get to lose us that quickly. Stick around for our conversation with John Brignola on private credit.